As homes become less and less affordable, and as interest rates go up and up and up, HomeLight actually did a survey where they interviewed over 1,100 real estate agents. And I've seen this too, and I've seen it in other stats, and I've heard it from Brian Buffini as well. More people are trending and purchasing homes that are not the typical norm, like the single person or the couple that's together. More people are trending and purchasing homes that are not the typical norm, like the single person or the couple that's together. Over 60% of these 1,100 plus agents have seen an increase in non-romantic co-buyers buying a home together. 43% of agents have seen an increase in parents, grandparents, and adult children buying homes together, or helping each other buy homes, basically. 24% of non-romantic buyers are not considering a mutual exit plan from the home. Is this good? Is this bad? Well, let's talk about the bad first, okay? So we can finish up with the good. If it's you and another borrower, all the credit scores are considered. So if they have a lower credit score, that is what's going to be used to determine the rate, and you may pay a higher rate. That would be a negative. All the debt is factored in. So if you have less debt and they have more debt, enough to cause a problem, well, they could weigh you down or cause you to not get the approval that you might otherwise have gotten on your own. Everyone is responsible, right? And so that could be good and that could be bad. And more importantly, that could be bad is if the payment is made late, it's going to affect both parties' credit. Both parties' credit. And the other potential negative is all parties have to agree to sell if somebody ends up wanting to sell. And what if the person you're buying with has no interest in selling and you're like, I am ready to cash out, baby? You might be stuck, right? So how do you fix those things? Talk about that first, and then we'll go into the pros and we'll wrap up. Do a legal agreement, okay? And on that agreement, put everything in there. Who's responsible for payments? How and when? Insurance, who's paying it? Taxes, who's paying it? Utilities, who are paying it? What if it's late? By what date? Then what action has to happen to ensure that credit does not get ruined? What has to happen or be agreed to in order to be able to sell and outweigh one person's opinion over another opinion? Those would be things you want to line out in a legal agreement. That legal agreement is going to help you to come to terms on what to do in all of those instances. And because you want to protect your credit and you want to make sure that everything's going to go well, one example would be we each put in money into this particular account by the 15th of each month to pay the bill on the 1st. And if heaven forbid somebody is short, then the person who's not short has to make up the difference so that payment is made on time on the 1st, no matter what. And if this other party is short 2 consecutive times, they have to sign over the house or something like that so that you can protect yourself and everything's in writing. Now, a lot of times what we're talking about is called multi-generational housing, where moms and dads are helping, kids are mixing with moms and dads, brothers and sisters, and it may be to where you're both buying a house so that your mother can live in, or maybe siblings are coming together for a handicapped sibling. There's a bunch of different ways that this can come to play, or maybe it's just you and your friend want to invest in property together. So let's wrap up today with the pros. But before that, my name is Stephanie Weeks. I've been helping with mortgage financing for 18 years. Thank you for tuning in. Please be sure to like, subscribe, and share. You can check out my book, Mortgage Peace, as well. And I'm licensed in multiple states and would love to help you. 985-300-LOAN or weeksteam.com. And let's wrap up with those pros. If two of you come together, and let's assume you both have decent credit, and now you both have jobs and you both have assets, a positive is you're probably going to approve for a lot more house than you might just approve on your own. And so I think that is definitely a pro that hopefully will outweigh some of the cons. The other thing is, let's say if that mortgage payment is $2,000, well, that might be a lot for you to cover on your own. But if you're partnering with other people and you're splitting that, half of that or a fourth of that is a whole lot less than covering the entire thing on your own. So I think that would be another really big positive. The other thing, like we talked about, is qualifying for more house. We've got splitting the payments. We've got, the other thing too I want to talk about is maybe on your own you don't have so much cash, but combined with other people, you'll have a larger down payment, which gets you into a better loan and gets you a lower monthly payment. So, and then also ease, if you're in a position, or a few of you are in a position to help that handicapped relative or help the elderly parents, or to be able to just buy a house and even all live together. Maybe it's not even for investment or for family. There's a lot of good that can come out of that and coming together. So I hope this video helped. I know it was short and sweet, but thought it was important with some of the changes coming through that we're seeing, and I wanted to make sure to share it and keep you up to date on what's going on in the market. See you next time.